Hello and welcome to the Business and Banking Dialogue Show, your daily one-stop show for the best of best in topics of financial world and subject matter experts. We are live across EPS channels, YouTube, Facebook, Twitter, and LinkedIn. Thank you for participating in today's show. Today we are going to talk about NBFC. The theme is what ails NBFC. As you all know, there is problems in the NBFC. The NBFC, or the non-banking financial company crisis, started with a failure of one of the most respected NBFCs in India, ILFS. You must have heard about it. Then followed the struggles at DHFL and Reliance. This NBFC crisis is unique in the sense that it is both a driver and a reflection of the economic slowdown. NBFCs create credit, especially among those segments of the population to whom banks are skeptical in extending loans because of their risky credit profile. So, NBFCs cater to those organizations and entities where they find it difficult to do the business from the banks because banks are unable to give the loans. So NBFCs fill that gap. They fund consumer white goods, motor cars, houses, which creates that big demand in the economy. However, a vicious cycle has been created with the ILFS collapse. Adding to that, banks cut down their NBFC exposures, further excavating NBFC's funding positions when lending by and to NBFCs goes down. Demand in multiple sectors is affected, creating a kind of a vicious cycle. And in this, vicious cycle is where our NBFCs are stuck. So today, to talk about what ails our sector, we have Mr. Jaspal Bindra, who has come here before. You have heard him before. He's he's a symbol of our proud because he has been the ex-CEO of a very big multinational bank, Standard Chartered. So, I'm not, so without much ado, let me just get going with the program. Mr. Bindra, good afternoon and welcome to the show.
Good afternoon.
Thank you, sir. Thanks for coming, sir. So, I just gave a brief about NBFC. You can add to that, but tell us, what are the root causes of this crisis?
So I think, all financial crises typically have the same root cause. And this one is no different. I think it always starts with a liquidity crisis. And then there is some combination of liquidity and credit crisis. That sort of builds up. And then once you have liquidity and credit crisis, then you stop getting any more liquidity, so it becomes a bigger liquidity problem. So I think we've had the same thing. I think you described already, KK, that there was the fallout of the ILFS and DHFL, etc. And that sort of restrained the supply side in terms of funding into NBFCs. But the reason that ILFS and DHFL went into the problem, I mean, if we go back to their root cause problem, was basically an asset liability mismatch. They were borrowing short term for investing in very long term projects. In the case of ILFS, it was infrastructure. In the case of DHFL, it was housing. But both of them were long term asset financings against very short term borrowing. The short term borrowings were done because they were plentiful and available, but also because they were cheaper than doing longer term financing. And I think in the eagerness to expand margins and because the availability was also there, a lot of firms were borrowing very short term to finance long term. And I think that is what really cost them, because when the economy slowed down and there was the order book of these entities were not getting the same revenue flow that they were used to earlier, then clearly there was a gap between the revenue that was required and the revenue that was available to pay the short-term debts. And it's a series of debts that they each defaulted on. So ILFS first defaulted on a SIDBI ICD and then on a bond, and then similarly DHFL had 2 downgrades. But this all happened very quickly, and both of them moved from a AAA to a triple D to a single D rating in a very short time. And I think so in their case, clearly liquidity was the challenge. I don't think so there was any suggestion that the assets they had lent to were necessarily bad, but they were unable to monetize the assets in a short time, whereas the repayment burden was very heavy in the immediate.
Okay. So, Mr. Bindra, you said that the crisis was more of a, perhaps you mentioned about credit crisis. So my question to you is is NBFC credit, is a credit crisis? Is it a liquidity crisis? And what's the difference between the two that made the NBFC collapse? And or is there something else that that is not known to the people?
So I think there is it will be a case by case issue. I think the liquidity crisis has hit all NBFCs across the board. The credit crisis is not a challenge for every NBFC. It wasn't earlier, it isn't today, and I don't think so it will be uniformly applicable to everyone. Credit risk arises on 3 issues. It's either the sector you are dedicated to. So most people who are dedicated to builder financing have a credit risk because that whole sector has seen huge weakness. The other reason you can have credit losses is if you have a weak credit monitoring system where you are more driven by yields and less driven by, being able to analyze risk sufficiently. And I think that is a credit gap in the firm, and that sort of gives rise to credit. And the third is obviously clearly there are some cases we know of where there's fraud, where there's corruption, either by the borrower or in connivance with the lender. So I think those are the 3 clear issues where you can get into. So the last 2 issues of credit risk, which is either a gap in the credit understanding of the business or a fraud, I think those are more, they are more specific to individual entities. The first one on a sector would be applicable to all the NBFCs who are in that sector, but it need not necessarily be applicable to all NBFCs. Whereas liquidity crisis, I think other than a few AAA rated NBFCs today, I think almost everybody else has that challenge.
Okay. Yeah, one of the things I think we all know is that when everything was hunky-dory, ILFS suddenly had a problem. And in big organizations like this, nothing happens so suddenly. Suddenly we found that, hey, they don't have money, they don't have anything, they are like falling apart. And so that kind of created a lot of doubts in the mind of people, investors, as to it's what's going on. How come such a giant of an institution just fall apart in no time?
Yeah, so I think if you look at all the global failures when it comes to financial institutions, they are always driven by liquidity. I don't know of any bank that has fallen. I'm not talking about NBFCs now, I'm just talking about banks. Any bank that has fallen because they had bad loans, NPAs, they have fallen because if you have bad loans, you have to refurbish capital, you have to dilute your ownership at lower, market cap, etc., etc. It comes with some other challenges. But a bank doesn't fold up because, you have a larger or a higher percentage of NPA. It eventually folds up because you don't have the capital and then you cannot lend. And, it is always liquidity, either in the operating cycle or in the capital raising cycle or whatever else. But liquidity is the key. And that is why asset liability mismatch is such a critical risk that people have to have very good governance and policies around asset liability. I mean, I'm not suggesting for once that people should not have an asset liability mismatch, because the way things are, at least in the Indian market, there is no long-term source of finance. The longest finance you can get is 5 years, whether you get it from deposits or you get from banks or any other financial institution. Nobody is lending you much larger. Even the capital markets are not deep enough beyond 3 to 5 years. So you have to have a mismatch. But having 90-day money financing 10-year asset, that is a severe mismatch.
True. So basically that comes to the one point of compliance. Who are the regulators for NBFC? Does RBI come into the picture ever and kind of says, what's going on here?
Yeah, no, so technically NBFC licenses are issued by RBI. So they obviously ensure you have sufficient capital. You have to report capital adequacy to the RBI at every period end, every quarter. So yes, they do have basic information of the firm. What they don't do is they don't supervise NBFCs on a day-to-day basis. But I think, ALM is not something that the RBI will know unless they were sitting in the management on a daily basis. Even for a bank, what every NBFC has to ensure is that they have a policy, a prudent policy, and there can be a big range depending on how the markets are. So in the good times, there was no necessity for an ALM policy because the 90, 180-day money was available in abundance and at very good rates. There was no shortage of that supply. So I think at that stage, people chose to not be trigger happy, but they just felt that it would be a lost opportunity if they didn't resort to that. But I think it is the fine balance between how much you can afford and how much you can be sort of dependent. And I think obviously that supply went away very quickly once ILFS and DHFL happened. And that wasn't an expected situation. And clearly, it brings us back to the basic of prudence. Do you stay prepared for the worst, or do you live in reality, or do you just be very optimistic and make the most while the sun is shining kind of thing? And different people will take some different pull from there.
Okay. Yeah. Thanks, Mr. Bindra. Thanks for clarifying. So my next leading question to you is, are there fundamental issues in the NBFC model in India that need to be looked and resolved? And my second question to that is, how are different NBFCs affected?
Okay. So the NBFCs in India, predominantly, there are a few who are allowed deposits, but the bulk of the NBFCs in India are non-deposit taking NBFCs. And they have a typical arbitrage model. The arbitrage being they raise money at one point at a X price and then go and find borrowers at another point at higher rates of interest. So they are basically creating the bridge of the fulfilling a need at a higher borrowing cost with funds which they borrow from lower cost source. And I think that arbitrage model was working very well when people could leverage their capital 7 to 10 times. So, the ROEs were very healthy and you could obviously make great margins through this route. But clearly, till the risk appetite in the banks and the mutual funds and insurance companies don't come back, clearly one will have to live with much lower leverage. And if that is the case, then to get high ROEs or similar ROEs as people were used to in the past, the arbitrage model is going to be very difficult to solely work on. There will still be arbitrage model that will continue, but it can't remain the sole way of doing it. So the model will have to shift a little bit to co-lending. There will have to be a lot more weightage to create sufficient equity so that the ratings are superior, so that the leverage can be, the flow of funds can be more assured. So I think all NBFCs will have to rethink a bit how to bring in more equity, how to improve their rating, how to help, find other ways of doing things rather than just the arbitrage model. And I think a lot has already started happening, and we are seeing a lot of co-lending, a lot of assignments, a lot of securitization. Some consolidation in the industry has begun. I think a lot more of that will happen because scale has suddenly become far more relevant than it was in the past. So I think we're going to see quite a dramatic change in the sector.
Okay. And to help you go through this kind of change, because obviously you have to reinvent yourself because of the trouble that NBFCs are in. What have the government and the Reserve Bank of India done so far to kind of help that process?
So I think the immediate thing that the government, so let me go back a little bit. Post the ILFS and that scenario, the RBI stepped in. They allowed banks to increase their exposure to NBFCs because they realized the NBFCs were not getting sufficient credit. And one of the reasons for that was most banks were very happy lending to NBFCs very generously pre the ILFS situation. So they were obviously all maxed out on their 10% quota. They couldn't lend more than 10% of the asset. So the RBI relaxed that to 15% to give 50% more credit to that. And then, of course, they also gave different risk weightages, etc. There was a lot of encouragement by providing special refinance schemes within the RBI pool to help institutions refinance their exposure to NBFCs, etc. So I think the RBI did its bit there. But I think COVID now has thrown up new challenges. So when you look at from what has happened from March onwards now with COVID, the crisis that has been created for NBFCs is in the very immediate, they have to ensure service continuity. How do they still be able to meet the information and transaction needs of their customers with depleted staff, depleted offices, etc. The second is that there's clearly a demand slowdown. So revenue has shrunk. And how do they still carry on their businesses? So what kind of cost optimization can be done, etc. Clearly, the pandemic has thrown up a huge concern about social distancing, contact, etc. So digital channels to be contactless in your service, in your delivery of products, etc., is the third sort of challenge. Clearly, for the near to short to medium term, there is going to be a lot more remote working, and there's going to be a lot more digital platform operational for transactions, etc. So some sort of an asset-light model will have to be found. And finally, there is the whole challenge of productivity. How do you ensure that you keep productivity at high levels when people are, unable to move around freely and be at offices, etc. So I think these are the immediate problems, and these are more for the NBFCs to sort for themselves.
Yeah.
And then from the problem that still remains paramount in the where the government and the RBI can help is the liquidity problem. And I think they've announced several schemes as TL, TRO, PCG, PEG, all kinds of ways of helping NBFCs who are financing MSMEs, etc., housing, affordable housing, the MFI sector. And I think there is a intent on the part of the government and the RBI to ensure whatever support they can provide now and going forward. But the reality of the situation is that the mechanism to extend this intent into reality or into real in terms of implementation has to happen through the mechanism of the banks. And the banks are commercial organizations who have to clearly understand and meet the needs of their stakeholders. One of them being good quality assets, another being timely repayments, etc., etc. And in this environment, when there is moratorium and there are close downs, it's very difficult to make those assessments. And so the natural reaction is that let's just curb credit exposure. Why do you want to lend into the unknown? Why do we want to lend at a time when there are so many uncertainties, etc., which is then causing... So the intent actually is not actually being carried out on the ground in the way it was designed. And I don't think so anybody's at fault here, but each one is playing fair to its... The government feels obligated and is trying to do what it's doing within its own resources. The RBI feels both responsible and in a position of authority to be able to exercise some of these provisions. But the banks that have to extend this facilities feel themselves already overburdened by the legacy challenges and obviously not comfortable to take on additional burden on that front, as well as the scrutiny from investigative agencies, etc., which they are prone to. So I think each sector is having each step of the journey, there is a consideration which is sort of not aligned to the other. Until we don't have that smooth alignment, we are going to have a disruption. And the disruption is there to see. It is going to be even far more visible once the moratorium is lifted. And I think it is going to have a lingering effect for a while, much beyond the lift of the lockdown.
Yeah, that is true. So, any such disruption, it has a problem, no doubt about it. And also it throws up opportunities, right? So there are two things that, I think all businesses, let alone NBFCs, do is to reboot, restart, and reinvent themselves. So in the case of NBFCs, are the new business models to cut cost and leverage technology, let's say P2P funding, okay, person-to-person funding, or using artificial intelligence-based lending models? Are such thoughts being done or being strategized or getting implemented, or are they implemented? Because you are certainly facing a double whammy, because you have a problem on the liquidity side, and the COVID has hit you badly from a resources and economic activity point of view. So you really have to reinvent. So what are the steps being done there?
So I think everybody has got their thinking caps on, is my assumption, and everyone is trying to relook their business model, the environment, the need to stay in or exit, all of the above. And I think all of the things that you mentioned in terms of P2P fundraising, or in terms of lending as well, P2P, or in terms of AI-driven customer selection process, etc. They are all already in play. They have been in play.
Okay.
They still make a very small fraction of the total canvas. So they are still small. They will continue to grow. The pressure to, the compulsion to grow those will be even larger now than it was before. Earlier, it was a nice to do. Now it will become a more necessary to do. But it will still not be the whole thing. It's like when we talk about energy sources. You know, clearly solar is great, and you know, nuclear is even better, and fossil fuels are bad. And over time, there'll be more alternative sources of energy than we have today, but it will never be the whole. We will never get rid of fossil fuel, at least for the foreseeable future. And I think it's the same with the physical versus digital elements of financing. And there are certain financing needs which people are unwilling to make digitally. So let me give you some examples. And again, this would differ by different people. Like most people today in India, even to buy a thing like a washing machine or a toaster, or even if they're replacing exactly the same model that they have already in use today, they want to go to the electronic shop and look at it and then make a digital payment thereafter. But you can't do an end-to-end digital. So the customer has to be attracted to a physical location. It's no different for cars. It is no different for housing. It's no different for anything that is a material spend as a percentage of disposable income of an individual or a family unit. So I think there will be elements that will remain only hybrid digital and hybrid. There are also sectors where, like in the MFI or in the rural sectors, where reach and touch and knowing the person you are dealing with is equally important to the product and the service you're providing. And I think in those circumstances also there is that challenge. So clearly all the technology is going to get leveraged far more than it was being done before. I think people are going to invest far more in technology platforms than they're going to invest in brick and mortar going forward. But the net situation is that there is still going to be a mix of both, and that mix will keep changing in favor of tech platforms over a period of time, but that may be an extended period of time. But in India, actually, we have a different challenge as well. In India, we have a situation where we are still very under-penetrated. So there are going to be a lot of first-time users of credit. It is very difficult to expect a first-time user of credit to be entirely comfortable on a digital platform end-to-end, or even small bits of the transaction. They want to understand, they've never done this before, they've never filled a form, they've never had an account where EMIs are debited, etc., etc. So, you know, there are those kinds of learnings, and that's going to be a very large and growing part of India's numbers. The second thing is that there is a very large part of India's business need, particularly in the MSME sector, which is met from informal sources. That is non-banks, non-NBFCs, non-housing finance companies, not registered institutions, but money lenders, family and friends, you know, broking institutions, etc., who do that business. And for them to convert, and they have only been used to a non-digital, that business doesn't happen on digital. And for them to, if they were to graduate to the formal system, again, their transition will be through a non-digital journey. And then they will get educated and familiar and comfortable. And, you know, for all the ills of COVID, I think the one thing that is the big positive of COVID, if one was to count anything can be positive out of COVID, is the familiarity people have developed and discovered during this COVID period in ordering online.
Yeah.
Housewives, homekeepers were just so comfortable ringing the phone to the vendor and getting their supplies delivered to their home. And now, because of compulsion and circumstances, people have been doing delivery, and now they realize, hey, this is heavenly. I mean, this is wonderful. I don't need I'm not dependent on anyone. I can do it in the comfort of my bed. I can do it any time of the day. There's a very clear tracking system. I don't have to keep following to chase up. The billing system is very transparent, and the prices are good, and the quality is fantastic. And so, so I think there is a process like that happens. So it's the same people who had phones, who had the same requirements, who knew there were these services available, but just in the run of their daily lives, never bothered to, exercise or use this option. But now, because they had all the time, and so I think there is that process. So yes, all of that will happen, I think, but it will happen over time.
Okay. Thanks, Mr. Bindra. So ladies and gentlemen, we are discussing about the NBFC, and they are in trouble. But so are many institutions in trouble. We have passed the half an hour stage, and the Q&A box is now open for any questions that you want to ask Mr. Bindra directly. You could also, as you know, ask questions directly to him by raising your hand, and our digital team will enable you to ask the question to Mr. Bindra. So having said that, so one question I have is that, did Reliance on costly, I don't mean the Reliance company, did Reliance on costly and fickle bank funding exacerbate the crisis, that is, accelerate the crisis?
So I think, the crisis was caused because there wasn't sufficient credit available to the NBFCs. Some of it because of their own fault. They were not good with their credit discipline, etc. Some because they were, for reasons of corporate governance, etc., not well rated. And then once ILFS happened, then every NBFC was looked at with suspicion from the lending side. So clearly, the banks then withdrew their comfort and appetite for the NBFCs. But the reason that there was a huge reliance on banks was more because the debt market is not very deep. And particularly for less rated companies, it's actually unavailable. So that is a problem. And that's a rare phenomenon in India, because any market of India's size, anywhere in the world, the debt market is actually a significant multiple of the equity market. It is only in India where the debt market is a fraction of the equity markets. And I think that has been a real problem. But because the banks, people were comfortable doing it with the banks, etc. So when the banks dry up, the alternatives were very limited. So you were left with mutual funds, you were left with insurance companies, but that's about it. Now, if we look at in the more recent term, because in the old days, the only people who went to the bond market were the very blue chip AAA, HDFC kind of companies who could raise money and that. But more recently, because the banks have dried up and the mutual funds and insurance companies have also been shy of lending to NBFCs, we are seeing the top-rated NBFC companies now look at external commercial borrowing. look at the bond market more frequently in India as well. And we are seeing some early signs where the top-rated NBFCs are getting support from that market. So I do believe that over time, people will explore the bond market more vigorously than they had the enthusiasm for before, because money was easily available from the banks, and that was much more transactionally just more convenient and simple. But now I think we will see the need for alternative ways of financing, and clearly securitization, bond financing, capital markets will come into play a lot.
So that's good to hear. Actually, my next leading question was if banks are unable to extend credit for whatever reasons, can NBFCs access the bond market? That was my next question, and you already answered that yes, you can access. So NBFCs are allowed to access the bond market, and you can, and some of the NBFCs are already doing that. That's what he said, isn't it, sir?
Correct.
Okay, so that's good to hear. So there is some avenue of you look at various alternatives, and so one of them is bond market. There could be many other alternatives, I'm sure the NBFCs will discover. So let's take a question, sir. Let's take a question from a regular participant and a very, very experienced banker, Harish Prabhu. Harish, could you unmute and ask a question?
Yeah, hi, good afternoon, Jaspal.
Hey, hi, Harish. How are you?
Fine. Jaspal, I mean, the NBFC model, in fact, I run an NBFC right now. So isn't the NBFC model by design a niche play, right? Given that they go down on the credit risk spectrum compared to a bank, and they actually fund an identified gap, right? Hence NBFCs from a regulatory perspective have a clear arbitrage by design, right? There's no SLR, CRR, and leverage standards which are available to them are, like a bank, right? And normally corporates don't get the luxury of leveraging like an NBFC. Hence, and I've tried to understand the NBFC sector, where the most successful NBFCs over a long period of time have been the captive NBFCs and funding a particular asset and, creating their niche. So if you see the likes of the, let's say Mahindra Finance, Bajaj Finance, TVS Credit, etc. and all, you've not, while they had initial problems and all, but they built successful models with all the, checks and balances in place. So isn't the NBFC model also should be encouraged from the point of view of, play to your knitting and specialize, fund only specialized asset classes?
Yeah, I think, very few NBFCs have stayed pure play. So if you look at globally, the big ones in the old days were Ford Credit, and they would finance all Ford vehicles.
Correct.
At one stage, Tata Capital was doing that for its commercial vehicles. But I think over time, they all sort of feel the urge to grow out of a captive. So even, I think you mentioned Bajaj. Bajaj started financing its two-wheelers, but now does everything outside of Bajaj products as well. And does the whole range. In fact, it might be of some amusement. They also finance goat financing during Eid. So it's the full range. So they see opportunities, they have the platform, they have a cost efficiency, they have the funding potential available to them. So what they are trying to pick opportunities. So I think it is still correct to your point, Harish, that yes, if there is an opportunity, whether it is captive or not is one issue. Clearly that is a opportunity. But I think even otherwise, there should be a specific purpose. I think people who are sort of saying we'll do everything ad hoc on an opportunistic basis is not right. And I think those people have suffered, as you would have noticed as well. But people who have chosen stance, but to me, I think that because the subject today talks about what ails NBFCs and the crisis and all that, we are saying all of that. I'm of a very firm view that NBFCs are here to stay. It may not be the same ones, or the ones that are there today may look different in time to come. But the need there, the purpose they are serving is of such immense value to the country. And I think it is, very commonly in parlance, people talk about NBFCs serving the higher end of the risk curve. That is not necessarily true. Because if you look at the MFI sector, which would probably rate as the highest of the risk because it's unsecured, it's to people who have had no credit history, they are doing things where they are vulnerable to everything from the weather to, bullies to everything. And they have a significantly lower NPA than any private bank. I'm forgetting PSUs. I'm just saying, than any private bank, including the ones we talk about with huge respect.
Sure.
So I think it is not that. I think what NBFCs are providing is a reach, which the banks are not interested because the ticket size is too small. And as you mentioned before, because of their overall loaded cost of CRR, SLR, etc., it's not really sometimes completely viable for them to be doing that on a full-scale basis. And also the opportunity available to them is so large outside of having to do these niches that they don't feel the motivation to go ahead and do that. When both you and I used to work for our previous companies, our companies only wanted to deal with people who were top of the industry, who were blue chips, listed, very seriously profitable for several years before they came to us, etc., etc. And you would argue that, why is that the need? I mean, there is, there's more money to be made elsewhere. But the thing was that there was so much choice there that people said, and I'll give you a very good example of the foreign bank. I mean, we would go and hire for the same entry-level positions in the US and in the UK, we would hire graduates. Whereas in India, we wanted to get day zero of IIM Ahmedabad. Because it was available. Because, they were available to come and join foreign banks. Those guys were not interested in joining a commercial foreign bank in London or US. So I think there is this thing about the banks just feeling the need. So actually, HDFC is a very good example. So the HDFC bank does everything that a private bank would do in India. And then HDB, which is their NBFC, does everything that you and I are doing, Harish.
Sure.
On a very big scale. So I think we can't say that HDFC has two different value systems or risk sort of criteria. But they just feel that through the NBFC, they can build it in a way where they can attack low ticket items, make it optional. I think to me, the biggest competitive advantage that people like HDB and Bajaj Finance, etc. have is to be able to process very high volumes of low ticket items, quick turnaround, profitably. And I think if you can do that, that is a skill set that the banks will never have.
In fact, I'm experiencing that. I'm funding a lot of no income proof and new to credit customers. Small ticket sizes are 25,000 to 40,000. Anyway.
That's right.
Thank you for your experience. Thanks.
Okay, Harish.
Thanks, Harish. Very good question. And thanks, Mr. Bindra. Very good. So you talked about, we talked about the credit from the banks, which has become a little bit not getting through. The flow is not there. We talked about the bond market. So would a securitization market help NBFCs to broaden their source of funding and thereby bring more stability?
Yeah, so I think the securitization in some form, it's not as sort of product packaged as it is in the developed markets like US and others, but there is an in effect a securitization market available in India as well, and it's done through assignments, it's done through other ways, sell downs, etc. And those are there, and institutions have used it, but the source of doing it is the same. You have to go back to the bank treasuries to do it.
Yeah.
So there is no separate market for securitization. There is no player who is saying, I'm just here for securitize. We have created the ARCs for the distressed assets.
Yeah.
But for regular healthy assets, there is no such entity or product that is being catered to right now. So basically you are in the same pool. It's just a different way. Instead of getting a loan on collateral of your financing, you get it by assigning or selling it down. Then there's some profit sharing, or there's a first loss guarantee. Various structures around it come about. So yes, it is another source, but the core source is not different. Whereas the bond market is a different supply side. There is. So we don't have the pension market here. We don't have the insurance market is much smaller. The mutual fund is much smaller. The bond market is negligent. The securitization market is not there as an independent source. It's the same as the banks.
Okay. So before I take the next caller, let me just ask one more leading question on the securitization market. 2008-9, the big black swan, as we call it, though COVID may be a bigger black swan. Isn't securitization a bad word after the financial crisis of 2008-9?
Well, after 2008, 2009, a lot of words have become bad words. Yeah? And so clearly, when you look at from a bank's point of view, securitization was one of the instruments that was overused. Many others, I'm putting it mildly, some would say it was abused, but clearly it was something that was to overtrade. People were over leveraged through securitization. So clearly that was a problem. And that is why compliance has become such a domino the impact of compliance and the complying with the compliance requirements, etc., have become so domino now in every institution since then because of some of these lapses. And then, closer to our sector that we are talking about, NBFC, since ILFS, even NBFC has become a 4-letter word.
Okay. All right. So let me take a next question, Mr. Bindra. It's coming from the media. Mr. Tripathi from ETV Bharat would like to pose a question. Go ahead, sir.
Good noon, Mr. Bindra.
Good morning, Mr. Tripathi.
Sir, wanted to ask you, there are two things that I need to ask you. First thing, yet another extension of moratorium, it has become a hot topic. Some people, they have voiced their concerns against this thing. RBI should not offer yet another extension, whereas some people have demanded it. And do you think it should be extended by another 90 days because COVID is still going on, though unlock is simultaneously going on? And whether there should be two separate approaches for two separate categories, like home loan borrowers and like businesses, those who borrow for working capital requirement.
So I think on the question of moratorium, it's very difficult for me to guess which way the government will weigh between the demand for it and the suggestion that it should not be extended. But let me tell you that irrespective of which stand the government takes, there will be a lot of people who will not be able to pay their dues just because the lockdown is lifted on a particular day. Because for firms that have had loss of income for 4, 5, 6, whatever number of months before the lockdown is lifted, there is no way they are going to have the kind of reserves in cash to suddenly be up and running from the next month and satisfy all, not to forget about the dues of the past, which become also accrued and become interest bearing again. But what about the current as well? So I think there is a need to meet that. Now, how much of that is genuine. Some of it maybe people are just stocking up and wanting to stay very secure and keep some cash handy, etc. I mean, who makes that judgment? How quickly can those judgments be made, etc., is impossible. We are such a large country spread over so many, sectors and people and everything else. So I can't see there to be an easy solution. The people who are saying that there should not be a moratorium are suggesting there should be a one-time settlement, restructuring. How do you do a one-time restructuring on day one? I mean, the one-time restructuring will involve several discussions with the lending institution and the borrower to understand, for the lender to understand the borrower's needs and the gaps, etc., for the borrower to be able to make an assessment of going forward with an uncertain demand. How do you know? I mean, how does a restaurant owner wake up in September and say, okay, now, I used to do 100 revenue earlier, pre-COVID, I will now do 80, or I'll do 60, or I'll do 30. So how do you do the restructuring? So I think there are challenges on both. I think on restructuring, it will be tough to predict till the demand patterns are not known. The production, the supply chain patterns are not completely back to normal. Moratorium, on the other hand, is easier to sort of allow to happen. But clearly there is a risk of some people being far too insecure and just choosing to hold cash and not pay back, and then create more challenges for themselves because they're just going to have a higher interest burden in the future.
What about home loan borrowers? There should be a distinct approach for them, home loan borrowers. And is there any case for further cutting down the interest rate?
Yeah, I think, so two questions there. I think, most lenders to home loan borrowers will be more comfortable because there's at least a secured asset, there is surface at the end of it, etc., etc. So I think there is more comfort. But the reality that we are noticing in the market, Mr. Tripathi, is that of all the lending businesses, the lowest moratorium is being taken in home loans.
And what about the possibility of yet another rate cut by RBI?
I think there should be. I mean, there is no reason. I think with what we are going through, a low demand scenario, it should have a deflationary impact. And clearly, I can't see interest rates going up in the near term. How much they will go down is a little bit also of a strategic tactical move by the RBI as to when they choose to reduce by how much. But clearly, I think it will be very safe to say interest rates are only headed one direction. At what pace, I can't tell.
Thank you. Thank you, Mr. Tripathi. Good questions. And I think Mr. Bindra, as usual, have answered it so well. I have a question to you from Mr. Saravanan, Mr. Bindra. What are the strategies NBFCs can adopt in wholesale lending in the current market conditions, is what Mr. Saravanan asks.
Sorry, could I get that question again?
Yeah. What are the strategies NBFCs can adopt in the wholesale lending in the current market conditions?
So, I mean, it's very difficult to give a broad answer because a lot will depend on the sector, a lot will depend on the liquidity position of the NBFC, a lot will depend on what is the, where you are geographically, because I think if you are operating from cities today, if your model is to do city, big town business, then you're more at a disadvantage. If you're doing tier 3, tier 4 towns, you're more at an advantage. So I think it's very difficult. But clearly, if the leverage is not there, to be lending wholesale right now is a risky proposition.
Yeah. Okay. Thanks, Saravanan. Mr. Bindra, we spoke about credit from banks. We talked about securitization. We talked about bond market. Another avenue is NBFCs borrowing from mutual funds. However, that seems to be on a decline for the last 6 quarters. What are your thoughts there? So why is it that we are not able? Why is the NBFCs are not too keen borrowing from the mutual fund market?
I think NBFCs will borrow from anyone. I don't think so. They are being choosy. They are not getting the same level of supply from the mutual funds as well.
Yeah.
And again, it's, the mutual funds are answerable to their unit holders. And today it's, and they have choices. They don't have to lend to the NBFC sector. They can lend to pharma, they can lend to anyone else. So I think people are choosing to, restrain themselves to sectors that the environment is supportive of. And I think if one took a holistic view and said, the credit demands of India are X, and the penetration of the banks and NBFCs combined is only a very small portion of X, and so there's a big market. But that's a kind of view private equity funds can take over a 5 to 10 year period. Mm-hmm. But for mutual fund unit holders who are doing, from an overnight liquidity basis to a maximum 18-24 months exposure, they want to go with the flow, and the flow in the immediate term is not with this sector. So clearly, they don't want to do hospitality, they don't want to do entertainment, they don't want to do financial services, they want to do pharma, they want to do healthcare, they want to do e-commerce. Clearly, those are the sectors that seem safe in the next immediate period. So I think NBFCs are suffering that situation.
Oh, okay. So let's take one more audio question. Tyag, could you please ask the question?
Very good afternoon, sir. Nice to see you back, and we could get a lot of insights. And being a non-banker, I can say that your message is very clear and highly informative. Coming back to the questions, industrial houses do have NBFC companies, right? So my question on, do they follow arm's length policy on transaction between or among the group? And do they indulge in related party transactions? And how are they monitored? Because a lot of lacuna has happened in the past. What is your view on how to fix the lacuna?
Thanks, Gab. I think there is a very strong, whether you are part of an industrial group or not, there is, by the SEBI rules, by the corporate governance rules, now there are very strict requirements on related party transactions. In fact, every related party transaction, irrespective of materiality, has to go through the audit committee, has to go through the board for approval. And forget, of course, that presupposes that people have independent boards and board members who will be conscious and responsible in delivering. But moving away from the board, even if you got away with that level of governance not being sufficient, the lenders today, and I'm talking about PSU banks, State Bank of India, do a very thorough check on related party transactions before they give a line of credit. They want to know, they want to monitor all usage of borrowed funds prior to their joining and giving you a line of credit. They specify end use of funds for what they disburse, and all the other PSU banks do the same. So actually, you have two levels of test on RPT, the related party transactions. One at the board level, which in itself should be very thorough in being mindful. And secondly, also through the lending bank. So I think there is sufficient check and balance in place. Clearly, people who choose not to play proper always find a way, I believe, and then that is different. But, that I don't think so there is any amount of regulation that's going to stop them. It's only they get caught when they get caught, and then the consequences thereafter.
Mr. Bindra, Mr. Tyag, thank you. Mr. Bindra, one question from a fintech person. He says, sir, what is your organization's adoption of new technologies or collaborating with fintech companies? Is there any thoughts you can give?
So on the new businesses that we have begun in the more recent 3-4 years, we are sort of digitized to the maximum possible.
Okay.
So clearly the back end is 100% digitized, and many other steps now. The government has also enabled, eKYC, etc. So a lot of the front end paperwork, but there are certain processes which still require a manual signature, which require paper stamping, etc., which we have to do, which we do. But to a large extent, whatever is possible, we have done. And the key is then, are we reaching to our customers entirely digitally or through digital and feet on street? And the answer in our case is it's hybrid. We do both. We do digital reach for all our products as well, but we also do feet on street. Some of our businesses are largely driven out of tier 3, tier 4 towns. So clearly we are finding that the cost effectiveness of reach is far better still, or not better, but not much worse off than a digital reach in terms of cost, but in terms of reach and effectiveness of the reach in terms of conversion of customer, the feet on street is more powerful. And then we have, once the customer is acquired, thereafter everything is done. And we work with several fintech partners, so it's not all done in-house. We have outsourced almost every step with somebody or the others. So we are working with the many partners in the fintech world.
Okay, thank you. So final question, because we have passed the hour. In the month of, I think, May, Union Cabinet came out with a policy to support struggling NBFCs. But they came with the condition that they are going to support them only for 3 months. And my question is, what is the point? What is the mechanism? What is the thought process in that?
So, KK, there are many schemes have come out of the government. There have been schemes that are, the TLTRO was longer term. There is another PCG scheme, which is 18 months. And then this one that you're talking about is more like a 90-day CP scheme that has come out. So I think different people have different requirements. Okay. Now it's really for the NBFC to choose. Most of them are, so even if this is not to sort of advertise our business, but I'll just, from the businesses that we do. So we do one supply chain business. The supply chain business is a 90 to 180-day rollover business. It's really bill financing, it's bill discounting, invoice discounting, bills of exchange discounting. So it's like what you would do on an electronic platform on Threads. You do either on Threads or you do physically. But there the funding requirement is required in cycles of 90 days. And so for that, this facility is perfect. But for most of our other, like for home finance or for something else, the financing is much longer term. So a 90-day doesn't solve my problem. I'm given to understand that the reason the government came out with this 90-day scheme was, one is it's easier to disburse and hopefully it will be quick. But it is basically to meet some immediate repayment pressures. But as I have said before, in reality, most of that money goes only to the AA, AAA top blue chip names who get one more source of funding at a cheaper cost. But really, they are not the most deprived players in the industry.
Thank you, sir. Thank you, Mr. Bindra. It's past the hour and we would like to wind up the show. Thanks for coming and participating once again and throwing a lot of light on NBFC. Yeah, surely NBFCs are in a kind of what we call mythologically a chakra view, you know. But I'm sure they will find a way out. There will be a Krishna who will take them out of this chakra view. So I hope to see better times for NBFCs very, very soon. Thank you, Mr. Bindra. Thank you all the participants and for joining me today. And I hope to see you again next week. Thank you. Bye-bye.
Thank you.